Financial risk management is the process of identifying, assessing, and mitigating risks that could harm an organization's financial health. It's about safeguarding a company's financial stability in a world full of uncertainties like market fluctuations, credit defaults, and operational failures. By managing these risks effectively, companies can protect themselves from potential losses while also positioning themselves to capitalize on opportunities. Before starting, don't forget to like and subscribe to our channel The Financial Feed for more future updates. Understanding financial risks. Financial risks come in various forms, each posing unique challenges. Market risk involves the potential for losses due to changes in market conditions, such as fluctuations in interest rates, exchange rates, or commodity prices. For instance, a company heavily reliant on imported goods might face market risk if currency exchange rates change unfavorably, making imports more expensive. Credit risk is the risk of a borrower failing to meet their financial obligations. This is especially relevant for banks and financial institutions, but also applies to companies that extend credit to customers. Operational risk stems from failures in internal processes, people, or systems, including risks related to technology, fraud, or human error. It's often more challenging to quantify, but can have a significant impact on a company's finances. Liquidity risk is the danger that a company won't be able to meet its short-term financial obligations. This can occur if a company can't quickly convert its assets into cash to cover liabilities, potentially leading to bankruptcy. Legal and regulatory risk arises from changes in laws or regulations that could result in financial losses. This might include changes in tax laws, environmental regulations, or financial reporting requirements. Risk identification and assessment. Effective financial risk management begins with identifying and assessing potential risks. This involves analyzing the organization's financial statements, reviewing industry trends, and considering external factors that might impact the company's financial health. Both qualitative and quantitative analyses are essential in this phase, helping to measure the likelihood and potential financial impact of various risks. Strategies for managing risks. Once risks are identified and assessed, organizations can employ several strategies to manage them. Risk avoidance involves steering clear of activities that expose the company to certain risks. While this strategy eliminates specific risks, it can also limit growth opportunities. Risk reduction focuses on minimizing the impact of risks that cannot be avoided. This might involve diversifying investments, strengthening internal controls, or investing in technology to reduce operational risks. Risk transfer shifts the financial impact of a risk to another party, often through insurance or hedging. For example, a company might buy insurance to protect against property damage or use derivatives to hedge against currency fluctuations. Risk acceptance is the decision to accept certain risks, especially when the cost of mitigating them outweighs the potential benefits. This approach is often taken for risks with low likelihood or minimal financial impact. Tools and techniques. Various tools and techniques can help manage financial risks effectively. Derivatives are financial instruments that derive their value from underlying assets like stocks, bonds, or commodities. They are commonly used to hedge against market risks. Insurance is a traditional method of risk transfer, providing protection against specific risks like property damage or business interruption. Hedging involves taking a position in a financial instrument to offset potential losses in another. For instance, a company might hedge against currency risk by locking in a specific exchange rate. Value at risk, VaR, is a statistical measure used to estimate the potential loss in a portfolio's value over a set period, given a certain confidence level. It's a widely used tool in financial institutions to assess trading risks. Stress testing and scenario analysis simulate extreme market conditions or different market scenarios to evaluate how these conditions might impact a company's financial health. These methods help organizations prepare for adverse events and develop contingency plans. Internal controls are essential for managing operational risks. ensuring that financial reporting is accurate and compliant with regulations. Risk Management Information Systems, RMIS, are software platforms that help companies track and manage risks, providing real-time data and generating reports for management. The role of corporate governance. Strong corporate governance is crucial for effective financial risk management. The board of directors is responsible for overseeing risk management activities, ensuring they align with the company's overall business strategy and risk appetite. This includes setting risk management policies, approving strategies, and monitoring their effectiveness. Corporate governance also ensures compliance with regulatory requirements and industry best practices, often involving external audits or consultations to review risk management processes. Regulatory considerations. Financial risk management is heavily influenced by regulations, particularly in financial institutions. Regulations like the Basel III framework for banks or Solvency II for insurance companies set specific requirements for capital levels, stress testing, and risk management practices. Compliance is vital for maintaining stakeholder confidence and avoiding legal penalties. Building a risk management culture. A strong risk management culture is essential for successful financial risk management. This culture starts with leadership, where senior management sets the tone by integrating risk management into the company's overall strategy. Employees at all levels should understand the importance of managing risks and be empowered to take action when necessary. Training, education, and communication are key to fostering this culture. Employees need the tools and resources to understand the risks associated with their roles and to manage those risks effectively. Open communication encourages the reporting of potential risks and sharing of information on how they are being managed. Challenges and the future of financial risk management. Financial risk management faces several challenges, including the inherent uncertainty of financial markets, the complexity of global operations, and the costs associated with risk management strategies. Despite these challenges, the benefits of managing risks far outweigh the costs. Looking ahead, the future of financial risk management will likely be shaped by technological advancements, such as artificial intelligence and machine learning, which can provide more accurate and timely risk assessments. Environmental, social, and governance (ESG) factors will also play an increasingly important role, as companies recognize the financial implications of issues like climate change and corporate governance. Globalization will continue to influence risk management practices, requiring companies to manage a broader range of risks, including geopolitical and supply chain risks. As regulations evolve, companies must stay informed and adapt their risk management practices to remain compliant. Conclusion. Financial risk management is a critical component of any successful business strategy. It involves identifying, assessing, and mitigating risks to protect an organization's financial health. By understanding the different types of financial risks and implementing effective risk management strategies, companies can minimize potential losses and maximize opportunities for growth. Effective financial risk management requires a combination of tools and techniques, including derivatives, insurance, hedging, and stress testing. It also requires strong corporate governance, a risk management culture, and compliance with regulatory requirements. While financial risk management presents challenges, including uncertainty, complexity, and cost, the benefits far outweigh the risks. By staying informed about industry trends, regulatory changes, and emerging technologies, companies can continue to manage financial risks effectively and ensure long-term stability and profitability. This is it for today's video. What do you think of our video? Comment below with your thoughts and let us know if there is any other videos you would like to see. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.